What are you making of all this here, Stefan, first of all?
Well, I think, as you've been reporting this morning, actually the story, it's about a divergence across emerging markets. So we have the case of Indonesia, where the central bank is knowingly making a trade-off between accepting lower growth in the future, but in exchange for that, bolstering financial stability in the short term via higher interest rates. And you see that the market reacting to that very favorably with the Rupiah strengthening. Then, as you commented already on this morning, we have cases like Brazil, where it's actually, far more serious. We have fiscal uncertainties. We have this election that is coming up. A lot more work has to be done, in particular in South America. We have the extreme case of Argentina, which has 40% interest rates, but the currency continues to fall. So it is really about divergence, and the market sort of applying, making a judgment call on those countries which are doing the right thing, moving ahead of the curve to address their weaknesses, and those countries which are behind the curve.
Absolutely, Stefan. You can't really tar all emerging markets with one brush, as
right.
some people tend to do. So,
right.
Argentina, Brazil, especially Argentina, it seems every 12 years or thereabouts we get into this mess there. But in the old adage, is it, trying to be greedy when others are fearful, or is it time to be fearful when other people are greedy?
Well, I think, for example, in the case of Indonesia, we're very impressed with what they're doing, and we have a strong call for further appreciation of the Rupiah, and so we are telling investors to buy there. And in other countries, you have to certainly be a lot more selective. And I think in the case of, for example, the Turkish lira, also Brazilian real, certainly I think more caution is warranted as we wait to see policymakers catch up with their predicament.
Stefan, you highlight Indonesia as being one opportunity. Do you see other types of assets or from certain EM markets where we have seen the dollar effect really weighing more than perhaps the country's fundamentals?
Well, that's a very interesting, question. Is it about emerging market vulnerability and weakness, or is it more about sort of dollar strength? And I think that's a very difficult thing to really sort of pin down. Broadly speaking, though, and as we saw from India yesterday, emerging market central banks are under pressure to be increasing interest rates, to be narrowing that yield gap that exists between themselves and the U.S. dollar. The rise in U.S. dollar yields has basically created this situation where, quite understandably, investors say, hey, I can get 3% in the United States. Why not just move my EM currency deposits to the dollar and collect that 3%? That poses an important challenge for emerging markets, and higher rates, all else being equal, is the only thing that they really can do.